So let me introduce Brian, our guest today. Brian is an acquaintance / friend of mine I've known for quite a while through an organization we both participate in called the Motley Fool. He is taken off and he's formed his own investment sort of, not idea service, but an investment sort of assistance thing he calls long-term mindset. Is that the right term, Brian? Okay, good. I subscribe to him. I follow him on Twitter. I follow him on LinkedIn. He puts all sorts of good content out there. I encourage all of you to do that. Brian, maybe a little later you can put your links out there for both your social media accounts so people can follow you there. I wanted to share my screen and show something he just sent today, which I think fits in just perfectly with what we do and how we approach things. So I'm going to share this screen. Here's an email that he sent today. I found really appropriate. It says, these are the different returns on investment one can expect. I know it's a little small, I apologize. But bonds are fairly low return on investment. Stocks are higher, which is what we're going to talk about today. But even more important, investing in your self-education, investing in your relationships, and investing in your physical and mental health. So Brian doesn't realize it, but he's actually a life booker. And so it's pretty cool to realize that he's thinking the same way that we're thinking all the time. Now I'll stop share here. So Brian, he's, like I say, he's very active teaching people, both in terms of his free content through his email, through his Twitter account, and through his LinkedIn account. He is also an author of a book, which I heartily recommend to all of you who are interested in investing. It's called Why Does the Stock Market Go Up? It's a really, really good starting text on understanding all that you need to understand to feel comfortable investing in stocks. And if you have not gotten the book, I strongly encourage you to do so. And in addition, Brian teaches a course on how to read financial statements online as well. So he's very much the financial educator, sort of a kindred spirit. So Brian, welcome here. Let me introduce you to who we are. This is the Lifebook community. And just like your slideshow, we try to take a balanced approach across all areas of life. And we value finances as just one part of the cog, right? One very important part of the wheel. But this is Finance Month in Lifebook, and we're here to hear your insights on investing, on money in general, and life as a whole. So, welcome aboard.
Awesome. Well, thank you so much for having me. As Sonny said, I've known Sonny for 6, 7, 8 years now, something like that. So it's great to have this community going. And yeah, I like that graphic shows, while most people know me as someone that like does stocks and the stock market, and like on YouTube, it's like I do a lot of individual stock analysis. I am deeply passionate about things that go well beyond money, and specifically using money as a medium to really live the life that you want. But that's a hard thing to get clicks on. So it's much easier to say, hey, this stock has got a 10x, and oh, by the way, stocks aren't that important. Live a good life.
That's right. Well, we do live a good life here, and that's our goal. But we're going to focusing today on investing. We're going to talk about how you got into investing. What was your investing journey like? How did you get started? Who inspired you to start investing in stocks?
Sure. So I was growing up, I was taught absolutely nothing about investing or the stock market. My dad he's an accountant. He became the CFO of a company. That company eventually got acquired by a public company. So he did have plenty of experience with accounting and the how to read financial statements, all that kind of stuff. But I was never taught anything about investing growing up. In fact, if you've watched The Wolf of Wall Street, you know that company that the guy made that was essentially a penny stock scammer. That was my dad's first introduction to the stock market. He got a cold call from them, and they were pitching him garbage, right? Just absolute garbage, but it all sounded good. So he bought some, lost money, and he would tell us, if this penny stock goes up, 50 cents or whatever, you guys get dirt bikes. And I was like, yes, come on, go, woo. And that was my first real introduction to the stock market, which was very confusing because it just seemed like a random number generator. Like some days it went up, some days it went down. On the up days, we were like cheering, yes, go. And on the down days, we're like, what's happening? We don't know. But I knew nothing at the time about business, financial statements, management, moat, any of that stuff that matters. The only thing I knew is that a number on a screen was going up and down. If it went up enough, that was really good for me. And by the way, we never got that dirt bike. However, when I graduated from college, this was 2004, my dad handed me a copy of a book called Rich Dad, Poor Dad, which was my gateway drug to finance and money and personal finance. For whatever reason, I devoured that book. I read it in like 2 or 3 days. It was the first time that anybody had ever explained concepts like you're in business for yourself. Anybody can become rich in one generation. The rich think about money differently than other people. They use taxes to their advantage, the power of corporations. And to this day, I have some qualms with that book now looking backwards, but I'm still so thankful that I got my hands on that because that has just kickstarted a never-ending love affair with money and investing. From there, that book is all about real estate and the power of real estate. This was thankfully 2005, 2006. So real estate requires quite a bit of capital to get into. I did not have capital, but I did discover that the stock market, you can get started with much less capital up front. I was a horrible investor at the start, bought the worst junk that you can imagine. If I was starting today, I guarantee I would be on Robinhood and Reddit and buying GameStop and buying AMC. I'd be doing all the things that we see other people doing incorrectly. But that slowly led me to reading about it. That slowly led me to the Motley Fool. And then I slowly started to digest the Fool, got involved with that, understood how businesses work. And I've just been in love with stocks and the stock market ever since.
I really like also, I'm following you in the Twitter. So your post is very, very easy to follow as well, easy to understand. So I really love the visual part. And especially the 15 timeless investing principles you share there. Mm-hmm. And there is one, the very last one, you said, if you can train your mind to celebrate during bull and bear markets, you have won. That sounds simple, but it's not easy at all. So how do you train your mindset?
Boy, that is a lifelong practice. I believe, especially when it comes to money and investing. Money is naturally a very emotional thing. I mean, money is like the #1 cause of divorce in the United States. And that's mostly because two people come together and they just have completely different philosophies about money. And they were taught completely different things growing up. And usually when I say taught, I mean they observed different money behaviors. They weren't actually sat down and taught how money works. And when you take the emotions of money and then all of a sudden you apply the stock market and investing to it, it just takes your mindset to a completely different level. It is so natural. It is so unnatural to be an investor that it's easy to understand why everybody sucks at it at the start. I mean, I certainly did, especially if you are a casual observer of the stock market, like basically everybody is. If you watch the news, you read the newspaper, what is the only thing that is talked about 99% of the time when it comes to the stock market? The price.
The price.
What did the price do today? What is the dollar value of the Dow, the S&P 500, the NASDAQ today, right? No explanation of what those things are. And by the way, I'm convinced 98% of people have no clue what the Dow Jones Industrial Average even is or means, but they do see that it's going up some days, it's going down some days. And the time that most people pay attention to the stock market is at the worst possible time. Naturally, humans take their cues from others, right? That is a natural thing that we have done since the dawn of humanity. And that is something that has served us well for centuries, right? For millennia. However, you have to ignore and go against all of the natural instincts that you have as a human being if you're going to do well as an investor. So if you start with the realization that you were pre-programmed to be horrible at investing, and that should give yourself permission to make mistakes and to get upset about prices going in different directions, and just understand that it is truly a lifelong practice of training your mind to actually become a good investor.
Awesome. And this is very true. Our fight sort of responses to stimulus in our environment leads us to exactly the wrong things when it comes to stock investing. So Tom Gardner, the founder of the Motley Fool, likes to say that the one thing he would wish all investors would learn first is to double their time horizon for what they expect to be in the market. What else would you give? What other advice would you give someone based upon what you've learned through the School of Hard Knocks or the University of Investing? Yes.
I think Tom's advice is great. However, that general advice falls apart when you double your time horizon from 1 hour to 2 hours, or 1 day to 2 days, or 1 week to 2 weeks. The thing that I would wish upon everybody, we have to get licenses to learn how to drive. There's no such requirement to learn how to invest or to put your capital at risk. I wish that just the history of what the stock market is and how it works was like required basic information for people before they started investing. If you show somebody a long-term chart of the S&P 500 and ask them, is this something that is worth betting on? It's immediately clear. Yes. Right? Look at the long-term trend. It goes up in a very squiggly line, but the long-term undeniable trend is, yes, the market returns somewhere between 8 and 11% annualized return over the last 100+ years, right? When you view it over that lens, it becomes obvious. It becomes obvious that the stock market is the greatest wealth creation machine in the history of humanity, period. Especially if you overlay that great Jeremy Siegel chart, which I can actually pull up, which shows the long-term returns of the stock market versus bonds versus T-bills versus gold versus cash, right? If you look at that and say, what is the best asset class? It's instantaneous. Stocks, period, end of story. The tricky thing is that is measuring the stock market over the appropriate time period. And the appropriate time period is decades. It's not days, it's decades. And when viewed through that lens, it becomes obvious what you should do with your capital. The problem is humans experience the stock market in real time. We live through it day by day. I mean, I personally was not an investor in the year 2000, but I did casually observe. I knew that people were making lots of money in the late 90s, and I knew that the dot-com crash was horrible, but I didn't have any money on the line. I wasn't experiencing it in real time. So when I look back and I see, oh my gosh, Amazon was trading for $6 a share, it's obvious what the correct action was to do now, right? The correct action was buy during while prices were falling. But looking back at a chart and living through that period, the period of 2000 and 2002 in real time, day by day, and just seeing every time you buy something, you lose money. And then every time you buy something, you lose money. And then every time you buy something, you lose money. That is a completely different psychological experience than looking back and knowing what the result is. So I would start by just saying, showing people the long-term chart of the S&P 500. And then I almost wish that there was a stock market simulator, like a bear market simulator, so that you could take your portfolio and put it in there and say, all right, let's pretend today is December 1st, 1980. Let's see what happens to our portfolio over the next couple of months. And it went forward day by day to be like, oh, look, we're down. How do you feel? Oh, look, we're down. How do you feel? Look, we're down. How do you feel? And really actually simulate the numbers that you are going to see on a screen if you start investing. But to me, step one with investing is education, period. Just start by educating yourself about the extreme basics. And once you master the basics, then put your capital at risk.
My question is, if you have the chance to meet actually your younger self, maybe your 20 years old self, what would you say to him?
Well, going backwards, I would say that everything has worked out pretty well for me in the last 20 years. And I know that I went through a lot of painful lessons really early on. I made a lot of dumb mistakes, but that was like the best tuition I ever paid and the best tuition I ever could have paid. At the time, it felt awful to lose hundreds of dollars in short periods of time. But the lessons that I've learned since then, I've made back, 100x a fold. So of course, I wish I could go back to myself and I know this sounds like a plug. I wish I could give myself my book. That is literally what I wrote my book for. I wrote it for myself when I first started investing. I wish I had that general information about what the stock market is, what the Dow is, why stocks go up and down every day, why they go up over the long period of times. I didn't have that basic education. So I had to kind of back into that by studying it for long periods of time. But I would not change anything that I've gone through over the last 18 years, including all the mistakes that I made.
One follow-up question. What has been your biggest investment mistake and the best investment?
The biggest investment mistake, excluding obviously all the cheating ones where you say, well, I should have just put everything into Amazon on day one and that's it, right? Excluding those, my biggest investing mistakes, all have one word in them: sell. My most costly mistakes all have the word sell in them. On a percentage basis, the dumbest mistake I made was selling a company called Dexcom. I bought Dexcom, a company called Dexcom, in 2006. At the time, I was working in the diabetes industry. I knew Dexcom's products really well. I knew how big the opportunity was. I had a rough idea of margins, and I just knew that the potential was enormous. Dexcom, I owned at a split adjusted price of about $1.30, something like that. The current price is $90. So I missed out on a 70 bagger or so simply because I was in a rush. So I bought Dexcom for a split adjusted price of $1 something, and I sold it a month later for $1 something plus 10%. And I was like, oh, I got to book my gain, right? I'm up on this stock. And of course, the correct action was to buy more, not to be in a rush to sell. But I've bought plenty of stocks that have lost me money, tons of them. I've even bought stocks with leverage that lost me money. But I still consider the worst mistakes, the worst investing decisions I've ever made was selling future mega winners early. Those are painful. Because it was just, I had a winning lottery ticket and I simply didn't wait long enough to actually be able to cash it in. Conversely, the best investing decision I made was being an early investor in Tesla. I bought Tesla in 2011, I think, maybe 2012. This is true. David Gardner, the co-founder of the Motley Fool, made a recommendation to his subscribers to buy Tesla. I was immediately turned off by it. I said, absolutely not. No way. I want nothing to do with an auto company. I want nothing to do with losing money for years. And I want nothing to do with anything about this recommendation. And the next time I saw him, I said, Tesla? Are you kidding? Tesla? And then about 6 months later, I was like, there might be something to this. And I took a small position in it. And now it's my number one holding. Not because I wanted it to be, but because it grew. I just didn't sell it.
I'll share a story about Tom Gardner, David's brother, co-founder of the Motley Fool. Also, he used to have much more of a valuation mindset than David. It kind of came from two opposite extremes, rule breakers, rule makers, all that. And I asked him one time at one of our gatherings, Tom, why aren't you investing or recommending Amazon? It's this giant behemoth company. Why you've not recommended in any of your services? And he said, well, I think it's just a little too pricey. I'm going to buy it if it comes down to $260. If it gets to $260, I'm going to buy. Okay. It was like $280 at that time, $280. Well, Amazon did come down. It came down to $260 and about 50 cents. And he didn't buy. And since then, Amazon has gone up to what, 10 times, tenfold since that point onward. And if you got in earlier, it's 100-fold. So the lesson here is not just what is selling too early, it's not getting in. If you're afraid of getting into some of these companies. So the key thing about investing is get in and stay in. Get in.
Warren Buffett had the exact same thing with Walmart in the 1980s. He was ready to deploy massive amounts of capital into Walmart in the 1980s, but he wanted a slightly better price. Never ended up buying it. It would probably be Berkshire Hathaway's largest holding today had he done that.
Yep, that's right. Okay, well, tell us a little bit more about your book. The subtitle of the book is Everything You Should Have Been Taught About Investing in School, but weren't. And that's exactly what you cover. So tell us about what kind of, I mean, there's a lot of material in this. The chapters are short, a lot of chapters.
By design.
By design, exactly. So tell us more about your book.
So I, again, had my, quick little story. When I graduated from college, I got a job at a startup medical device company. And I graduated with a business degree, still had no clue anything about stocks or investing or money, nothing, right? We studied like marketing and law and accounting, not all that kind of stuff, nothing about investing. I feel like I was cheated quite a bit by that simple overlap. But I vividly remember my first day on the job. I'm sitting down with the HR director and they hand me the 401k packet, right? I open it up and it says, do you want to do high growth, medium growth, or low growth? And I looked at her and I said, what do I choose? She said, I'm not allowed to tell you that. I was like, well, this seems like an important decision for my financial future. I literally have zero education about what any of these terms mean. So I was like, 100% in high growth. Done. And I often think, looking back, what do I wish I knew about the stock market then so that I could actually understand what the heck I was doing and what the heck that I was signing up for. So when I was writing this book, the very first thing I did was I thought of every single question that I had about investing back then, and some of them are extremely basic. What is a stock? What is a stock? Why do stocks exist? Why can I purchase shares of Apple? Why am I allowed to easily become a shareholder of Apple? How come? That is a weird thing when you think about it. What is the stock market? Or how about this one? When I buy shares of Apple, does Apple get the money? Or who gets the money? Right? It just disappears and I get a share of stock. Those are very common, easy, fundamental questions that I didn't know the answer to. And I just know after speaking with lots of people about this, that those answers are not common knowledge by any stretch. So I wrote down every single basic question that I could think of about the stock market. And then I organized them by category. And then I did my best to explain in as simple of terms and using as simple language as possible, the answers to the question. So I was really trying to, when I wrote the book, I was trying my best to maximize for readability, to make it the language extremely easy to understand. In fact, it came in at under a 5th grade reading level, which is something I'm really proud of. And then Two, make it feel that like it's a book that you're quickly making progress on. I've had people tell me that they read it in an afternoon, right? And that makes me feel great. Like I wanted this to be everything that someone with a 401k should know about investing, but doesn't know where to go and is not interested in investing. So I optimized for simplicity. And when I was writing it, I reached out to many of my friends. I asked them how they invest their money, what they know about the markets, what questions that they had. So I crowdsourced as many questions as I could possibly think of. And I just did my best to answer them as simply as I possibly could.
Awesome. And for those of us who are not in the United States, a 401k is an investment account that is tax advantaged. So when you go to an employer, you'll often have the opportunity to put money into an investment account, and the company will often match your investment up to a certain point. And so you get double the advantage and you don't pay taxes on the money. So it's encouraging people to invest. But as Brian says, most people don't have a clue what they're doing. They just have this opportunity, but they're not prepared to understand what's going on. And I think that the finance industry as a whole relishes that obscurity and takes advantage of it by charging you for the privilege of managing your money. But if you do understand and take the time to learn this, and again, this book is a great start. It's a fabulous start to understand all the jargon that you hear all the time. Then you can do this on your own. And that's,
Let me ask you a question. Let me ask you a quick question, because this is something that I struggled with. If, let's say, you're a family member who knows absolutely nothing about the market, zero, like they're starting out at zero, came up to you and said, I'm interested in learning about investing. What do you suggest I do? What book do you suggest I read? Without saying mine, what is the first book that comes to mind?
I probably would not direct them to a book first, but if I had to, let me think about that. Probably One Up on Wall Street.
Great book.
Yeah.
Great book. And that's one of my go-tos as well. And I just think I read One Up on Wall Street. I read The Warren Buffett Way. I read everything by Seth Klarman. I read about Benjamin Graham. I read the Motley Fool books, all fantastic, great books. But I just felt that there was this missing book out there that was just purely the stepping stones to understanding the extreme basics of the market. One Up on Wall Street is Peter Lynch's books are fantastic, but I don't think that those books are about picking stocks.
Right.
That to me is something that applies to 1% of the population. Right. And that 1% is simply people that are interested in learning how to pick stocks. That's the only requirement in my book to picking stocks. Are you actually interested in doing so? In my experience, 99% of people are not interested in digging through SEC statements, thinking about business models, reading financial statements, keeping up with the market. They're just not interested, which is perfectly fine. For those people, just put your money in index funds, dollar cost average, see you when you're rich in 30 or 40 years, right? So that is a big part of the reason why I wrote the book in the first place, because I didn't have a great, here's the first book you should read, and then go from there to all these other great books.
We were actually thinking about doing some book club. So maybe we should start with your book, Brian. And there is also a question here by Edward. Is that book recommended to non-US potential? So it's global, right? I think everybody can read that.
Yep. So it is available around the globe. It does center on the US stock market because that is the biggest, most liquid, most well-known. There are a couple chapters in there that pertain specifically to US investors. So like the 401k, the 403b, the Roth IRA, et cetera. So you can skip that part if you're international, but it's the principles of the stock market that are the really important parts to understand what stock markets are, how stock market works, and everywhere in the world, the Dow Jones Industrial Average, the S&P 500, and the NASDAQ are terms that are associated with the market, even if you are not investing in the US. So I would say that about 80% of the book is applicable no matter where you are in the world, and that remaining 20% is most helpful for US investors.
Very cool. So tell us a little bit more about long-term mindset.
Sure. So when I started writing the book, it was 2020. I knew that you face a really big uphill challenge when it comes to books. There's over 1,000 books that are published every single day. Every single day. The volume of books that are out there is absolutely enormous. And after speaking with several successful authors, they told me that if you want a book to actually have an impact on the world, marketing the book is an enormous task, and you have to do it. At the time, I had a decent sized Twitter following, a few thousand people, and I was posting fairly regularly to Twitter. So I really took Twitter and email and all the social platforms seriously in an effort to grow an audience that I could eventually market my book to. And just by having a sizable following, it helps you with convincing to get on podcasts and media and all that kind of stuff. So that was the impetus for me deciding to put so much effort into growing on social media. As part of that, I started a really simple email newsletter that I called Long-Term Mindset, which is just taking essentially my best tweets, my best ideas, visualizing them, and then emailing them out consistently. And I've just been doing that consistently for over 2 years, actually just about 2 years to the day now. And it's grown into being, I have about 40,000 email readers or so. And from there, I started a YouTube channel, and I've kind of gotten sponsors have reached out to me. So it's become the primary thing that I do. So Long-Term Mindset is just the name of my company and the name of my newsletter. And each week we just, I look back at history, and I find 5 pieces of content that I think are timeless in some way. So it could be a quote, could be a Twitter thread, could be a blog post, could be a YouTube video. And I send those out as just here are 5 things that will encourage you to think long-term with your money, relationships, physical health, and life.
So definitely let us know how our members here can subscribe to all of your feeds,
Yep.
whether they're email or YouTube or social media. That'd be great. Awesome. So let me give you a situation, and I want to get your response. I have a niece. She is in her mid-30s. She is a practicing physician. She's not married. She has no children. She has no pets. She keeps telling me she wants to sit down and learn more about investing, Uncle Sonny. She keeps saying, right? But she has yet to do so. So clearly there's this intellectual knowledge that she should be doing this, but there's also some sort of emotional obstacle from actually doing it. So my observation is your emotional approach to money and investing is far more important than your intellectual knowledge. I think Warren Buffett would agree with that, and many other classic investors would agree that if you can't stomach some of these little price fluctuations that the market will throw at you, then maybe it's not the right thing for you. What would you do? How would you coach me to get this niece to get over that threshold, actually start investing?
Well, I think the first step is always education. And I would start by saying, what is your current preferred way to learn things? Do you like watching YouTube videos? Do you like listening to podcasts in the car or going for walks? Are you the type of person that will sit down and watch a documentary? Do you read in your free time? What way do you consume media that has your attention? Like what is the current avenue that you do so? If she likes to go on walks and listens to podcasts, I would start with audiobooks. I would pick an audiobook that talks about investing or the stock market, such as one up on Wall Street. And I would say, just listen to this. Start with this. Consume the information in a convenient way for you, and ask yourself, does this content resonate with you in some way? Or you could actually take the first step for her and help her set up some kind of brokerage account with Vanguard, and just get the ball rolling with that. Inertia is such a powerful thing, right? So if you can actually sit down, say, I'm coming over for the next hour, the only thing we're doing is setting up an account with Vanguard. We're setting up an automatic investment plan. We're setting it up for simplicity, and we do that once, and then you never have to think about it again, and you'll thank me in 30 years. So if she's serious about that, a lot of times people literally don't know what the first step is. My sister-in-law, who wants to learn about investing, she was like, do I go to a bank? Like, how do I have money? How do I actually invest it? So people literally don't know that, yes, you should open up a brokerage account. Which brokerage account should I use? There's tons of choices, right? That kind of choices can all of a sudden lead to paralysis and prevent things. So I would say start with, what medium does she learn best in? Does she like with? And if you really want to really do her a favor, have coffee with her. Say, bring your laptop, bring your checkbook, and we'll set it up.
Okay, that was actually a question for all those folks here who are facing the same circumstance. That know they ought to be investing, but they aren't yet. What should you do? So there's Brian's answer. Find out how you learn best, because you must learn before you get involved. You must get to understand what you're doing, right? So find out how you learn best. Find some great material, or ask us for some recommendations about what you might want to start with in that particular medium, and then contact us and let us help you along the way. Get over the inertia, because that is the biggest deal. Is that first step, that buying your first investment is often a very daunting thing to do, but it's actually quite simple. Once you're prepared, once you're mentally
and we can actually use her disinterest can actually really help her in the long term, because the more she ignores it after she gets set up, the less likely she is to change anything when things are going poorly.
Yep, that's absolutely true.
Brian, there are members here as well who started investing maybe since March this year, and the Mr. Market is really irrational these days.
Mm-hmm.
Since quite 1 year from now as well. But the thing is, how would be your advice on these market circumstances for those investors who just getting started?
Well, if you're just getting started, what has happened since November of this year is quite literally best case scenario. The absolute best thing that can happen to you is you start investing and you learn with little bits of money how your emotions react when prices are going in the wrong direction. If you're the type of person that looks at that and is losing sleep, is checking it constantly, if you are feeling anxious about it, right? If you do that, then you just learned something really important about yourself, and you are actually learning what your real risk tolerance is. 2020 was a horrible time to learn what your actual risk tolerance is, because the riskier the thing that you bought, the better you did immediately. The worse the company, the higher your returns were immediately. And really, since November of 2020 up until today, that's when those investors have actually learned in real time what their true risk behavior is. So if you're feeling anxious about what's happened over the last couple of months, no problem. Adjust your asset allocation to damp down on the volatility. And if you just aren't cut out to deal with the swings and price, if you are actually losing sleep over that, no problem. Investing might not be for you. So invest more conservatively. Perhaps pick a different asset class, such as real estate. There are lots of people that do very well by investing in hard assets that they can actually control or touch. So if the swings of the stock market are causing your life to be worse, then perhaps investing in the stock market isn't for you.
Good advice. Very good advice.
The proper response to what's happening now is greed.
Mm-hmm. That's right. That's right. Actually, if you are prepared and if you do understand your own risk tolerance, this is the very best time to start investing, because the market is giving you bargains every, right? but you have to first understand that long-term perspective and not get shook out by what's happening over the last few months or even a year, which is really short-term noise when you're thinking in terms of decades of investing. So yeah, it is true. But yeah, initial early success can be the worst thing that can happen to you as an investor. That's a paradox that is very true.
The market is the worst place to learn what kind of investor you are, I guess, and learn first. And what do you think community or mastermind or the friends you have around, peers, will help you in order to actually improve your investment as well as to go through this journey? What do you think?
Community is incredibly valuable if you are an investor. Finding like-minded, long-term, not emotionless, but people that are in different emotional states than you are, and being able to talk to those people when you're feeling anxious. It's hard for me to put a dollar value on that. That's the community that I found and Sunny found years ago was the Motley Fool. And for those that aren't familiar, the Motley Fool, once you become a paid member, they had these thriving discussion boards where people were posting stock research, they were posting their portfolio updates, they were posting about investing lessons, they were posting investing quotes, and they were posting about how they felt on any given day. I mean, I learned more about investing by reading the thousands of hours I poured into those boards than probably all the books and audiobooks that I've read combined. It's just amazing. And the most important thing there is you can actually find digital communities like the one that you're in right now that encourage you to do the right thing. The fastest and the best way to level up any aspect of your life is to join a community where the default action in that community is the outcome you're trying to achieve. So if you want to become a runner, join a group of runners, because those people will place tremendous social pressure on you to make sure that you're actually running and actually hitting your goals. So community is huge.
Okay. My first experience was before the Motley Fool. We started an investment club. And again, same idea. You've got a bunch of folks kind of at the same beginning level of investing, helping each other weather the storms, make it through, get in ideas from another, and learn how to do the analysis that we needed to learn. And broader than that was the Motley Fool. And now here in Lifebook or over in our own community of Wealth Angels, we're trying to do the same thing. Right? We're trying to give you a place where you can learn these things, get encouragement, get solace if necessary, kind of keep on the right track so you can become a successful investor. That's community is huge, 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 huge. Someone asked what the number 2047 in the back of your on the back of your videos. What is that?
That's right. I turned 65.
You young man, you.
It's a reminder to think long term.
Yeah. That's cool. That's cool.
That was actually given to me at Fool Fest, Sonny.
Okay, nice.
One of my viewers 3D printed it for me, handed it to me in person. Very cool.
Just last week or whatever? Yeah.
Yep, just last week.
Yeah, that's cool. Yeah, Brian and I just attended the first live gathering of Motley Fool community members since COVID hit. And it was quite a nice event. Again, the community is so important.
Mm-hmm.
I thought it was your password somewhere, so yeah.
Yeah, it's also my password.
So where's your
just
brokerage?
keep putting 2047 in enough times and it'll eventually work.
It's essentially it's one bit short of one of the binary decimal places, 2048. Okay, anyway, that's too geeky for here. Anybody in our community? Let's open it up to folks who have a question for Brian.
Maybe you can raise your hand. So we are
raise your hand.
Yeah.
So we can see you.
And Brian, actually, I have one question or kind of small request. We would like to keep doing this maybe every single month. So if you have somebody you can introduce us to do this interview with him or her, that would be awesome.
Yeah.
Anybody in your mind?
But how about my business partners, Brian Withers and Brian Stoffel? Sure.
Brian, and Brian. That's a,
Yeah.
you should be a law firm.
Yeah.
Amazing. Thank you, Brian. Yeah.
Yep.
Anybody?
So I'd like to ask a question, just for a little bit more wisdom from you about the way the market works. Someone mentioned in the chat the term Mr. Market, coined by Benjamin Graham, is, the sort of insane person that keeps offering you a different price for your business every day, depending on his mood. And that's kind of what the market seems to be doing, right? So we have bear markets, we have bull markets. How do you prepare your mind mentally? By the way, I like Diego's pronunciation of it, the beer market. Because when the market's going
That was
down,
more
that's the
fun.
time to
Way
pull
more
out a
fun.
cold one. That's right. Pull out a cold one and just ride.
That's right.
But how do you prepare yourself for bear markets that are coming and bull markets that are coming, and position yourself as an investor in your mind space?
Or even one more animal, the kangaroo. It's going nowhere.
Yeah, the kangaroo market.
Yeah.
We might be in a kangaroo market for the next decade. It is possible.
Yeah.
I can tell you that what I do, what I suggest other people do. So when I think about my finances, I break them up into two buckets. There's my personal finances, and then there's my investments. And I think of them as two opposites on a barbell. It's called the barbell method. I'm pretty sure it was coined by Nassim Taleb. But I think of those two things as two distinct entities, and I treat them exact opposites. So my personal finances are as conservative as they could possibly be. I have them, the dial on them is all the way set to extreme conservatism. What does extreme conservative with personal finances mean? To me, that means zero debt. Zero, no debt of any kind. And that includes house, everything. I have zero debt to my name. That also means 6 months of fixed expenses in cash at all times, sitting there, earning next to nothing, losing money to inflation at all times. It also means multiple sources of income. Multiple sources of income, a high savings rate. So my expenses are far lower than my income. Those things provide me with such a rock solid foundation that I know it in my heart that no matter what happens to my investments, my actual real life that I live will have no impact at all. My family's lifestyle is not threatened at all by any volatility that we may face in the stock market. So that extreme conservatism with my personal finances enables me to deal financially, at least, with extreme volatility in my investment portfolio. So my investment portfolio is 100% equities, 0% anything else. Or it might be like 1 or 2% cash, depending on the day, because I know that portfolio is there to provide me with the lifestyle that I want when I retire, whatever the heck that means, down the road. So I know on a deep level that I can withstand far more volatility than the average portfolio manager can. And because I can truly withstand that portfolio, that volatility, and I can truly think and act with the long term, and also I can truly understand that I'm not going to fire myself, which is something that every portfolio manager does have to think about. That is the source of my edge in the market. It's that I can be far more patient than most people can be with their capital. And I know that if my portfolio goes down 50%, my lifestyle, my family's lifestyle doesn't change at all. It's mentally taxing for sure. It's mentally taxing to withstand that. But I just know on a fundamental level that what's going to happen today, tomorrow, the next day is going to be absolutely fine. So while we've experienced huge volatility over the last 3 years, I have lost zero sleep because of it, both on the way up and on the way down. So one, I would say if you should position yourself to be able to handle volatility. And I recommend the barbell method. The second thing that really helps me is studying market history. Studying market history. Everything that we're experiencing now is the same as it's been for the last 100 plus years. If you think the volatility we're experiencing now is bad, look up the stock chart from 1929 to 1936. Right? This is nothing. What we're going through now is nothing compared to what they had to deal with. Peak to trough, the indexes fell 89%. The indexes fell 89%. What are we down currently? 20, 30? I mean, it's not even close to being on the same planet in terms of volatility of what our grandparents and great grandparents had to deal with at the time. Although, to be fair, at the time, something like 2% of Americans owned stocks, whereas now it's more 60 or 70 percent. But I know if you study market history, what we've seen over the last couple of years is markets working the way markets work, period. And then you have to add on top of that social media and TikTok and Robinhood and meme stocks and groupthink like we've never had before, because it's never been easier to have groupthink that way we have before. Dealing with that volatility emotionally is challenging, but it becomes so much easier when your personal finances are taken care of first.
I could have paid you to say that, but thank you. That's exactly what I want to say. And I would use a little different word instead of conservative versus, it's wisdom in both cases.
Sure.
Wisdom with your personal finances takes you in one direction, exactly the direction you described. And wisdom about investing takes you in a different direction, where you take the longer term perspective, you can ride out the volatility. And this is how, as Peter Lynch kept trying to tell you in his book, One Up on Wall Street, you can do better than Wall Street, right? If you have the proper perspective. Wall Street has perverse incentives built into their system that prevents them from doing as well as they might otherwise. All right. You can actually, once you learn, and the more comfortable you get with this, the more you control your emotions, the better you are at selecting investments, you can actually outperform the professionals. And so different mindset for the markets than for your personal finances, but both involves the right kind of wisdom. Well done. I like that. I'll send you your $5 in the mail. Okay.
We agreed on 50.
Oh, I'm sorry. I thought it was 25.
Let me bring one member, Eric. Okay, so you can ask your question. Thanks for waiting.
Thank you, Diego. Thank you, Sunny. Thank you so much, Brian, for contributing to our community. This is awesome. I'm just beginning my investing journey, and I'm just curious. My father actually put me in a couple funds years ago. Looks like it says mutual funds. I'm just starting to learn the terminology. But one of them's a Vanguard Star Individual. One of them's a Vanguard Target Retirement. I'm trying to understand what these mean and what the difference is between like index funds and ETFs. I've heard that from the little knowledge I have that ETFs have a very low, are kind of the best way to go, even more than mutual funds. But obviously that's just knowing ETFs and index funds, like what's the difference, and then about these stocks.
Yeah. So the real difference between the things that you're describing is the difference between the words active and passive. So the word active just means that there is a human being, typically a fund manager, that is choosing what to invest in. The traditional way to do that is through a mutual fund. So a mutual fund is simply a pool of money that a group of investors put together. That money is managed by a professional money manager. And that money manager goes out there and attempts in the markets to achieve whatever the stated goal of the mutual fund is. Most mutual funds are out there trying to achieve long-term growth that is superior to the markets. However, that's not always the goal. Some goals is minimize volatility. Other goals is consistent returns, and even in bad periods. So that's active funds. And there are active mutual funds and there are active exchange traded funds or ETFs. Conversely, there are passive funds, and those are traditionally index funds. So whereas a mutual fund is picking through the stocks in the S&P 500, let's say, and trying to outperform the index, the index fund simply buys all 500 stocks in the S&P 500 index, if that's the stated goal of that index, and just owns them all and only changes them when the index itself changes over time. The difference between the two often comes down to performance, taxes, and costs. Index funds, because there's no investment decisions to make, there's no fancy manager to pay, are often a fraction of the fees of mutual funds. So most mutual funds cost, let's just say 1% per year for simplicity, whereas many index funds are 0.1% per year. So literally 90% less cost. Now that doesn't sound like much over any given year period. However, if you compound those fees, because fees compound too, over a couple of decades, it can make a massive difference in performance. Now, paying those extra fees to a manager can make sense if that manager outperforms the index after subtracting his fees. Unfortunately, the studies show that the vast majority of mutual fund managers can't do that. I don't think that's because mutual fund managers are dumb or bad at picking stocks, by the way. I think it more has to do with the structure of mutual funds themselves and the incentives of mutual funds. I think the game is rigged against mutual fund managers. So if you're just starting out and you just want to keep things as simple and as low cost as possible, index funds can be a great way to go. Now, you said index funds and you also said exchange traded funds. Those are essentially kissing cousins to each other's. Index funds are more like a mutual fund in structure. Mutual fund have some little quirks to them. You can't buy or sell a mutual fund during the day. It actually happens at 4 o'clock after the day closes, where exchange traded funds can be bought and sold during the day. But they're very similar. They're very similar to each other. But the big difference to note is whether the funds are actively managed and high priced or they're passively managed and are low priced.
Okay. So is there a higher return compared from index to ETF, or it's kind of variable?
It totally depends on, so the index fund versus ETF is like the wrapper for the fund, and what the fund actually invests in is the returns that you're going to get. So let's say you had an exchange traded fund that invests in the S&P 500, and you also had an index fund that invests in the S&P 500. Returns are going to be exactly the same. Quite literally exactly the same. But there are thousands of exchange traded funds and probably thousands of index funds that invest in specific things. So there's exchange traded funds, for example, that invest just in cybersecurity stocks, just in Japan stocks, just in semiconductor stocks, just in consumer good stocks. So there are plenty of choices for you as an investor if you think to yourself, I think fill in the blank industry is going to be a great bet over the next 10 years. And with an exchange traded fund, you can buy just the companies to play that specific trend. But the returns that you get are going to be based on what those funds invest in.
Got it. That's very helpful. Thank you, Brian.
Thank you.
Okay, there is another question I wanted to do as well. I think you also mentioned about in the principles of the timeless investing. In the beginning, your saving rate is all that matters. Over time, your investment returns become all that matters. And investing in this kind of, let's say, the basket of index ETF versus the individual, the student, or the basket. What do you think is kind of be like a threshold for a member or an investor go from ETF to invest in individual stocks?
Yes, to your point, when I first started investing, the thing that I was really spending my time on was maximizing my investing returns. Like I was just fascinated by the subject, still am, and I really want to outperform the index. However, if you do a great job outperforming the index, you could do so by a few percent per year, maybe even, let's just say you're a superstar and you get 5% extra return per year. Well, if you are just starting out and you have $1,000 in assets, an extra 5% per year is literally $50 in that first year. You will have a much bigger impact on your actual net worth by spending that extra time to make and invest an extra $1,000. That doubling your contribution rate, doubling your savings rate will have a way bigger impact on your net worth, as opposed to squeezing out as much extra return that you can. However, this exists on a sliding scale, and the larger your asset base grows, the bigger the investing return becomes as an importance to your overall net worth. If you have a $1 million portfolio, suddenly squeezing out 5% extra return generates $50,000 in excess value. For many people, they can't save $50,000 in 1 year. Many can't even save a fraction of that amount. So as your portfolio grows, the importance of your investing returns dominate. But in the very beginning, the savings rate, the amount of capital that you put into the market, is really all that matters. And you need to determine where you are on that scale, and that's where you should focus your time. I was going to share a graphic, but I don't have screen sharing abilities. I don't know if you can turn that on.
Can you try now, Brian?
There you go. I'm a fan of simple graphics. So it's just about where you are on this sliding scale, right? So if you're just starting out, focus all your energy on your savings rate. If you have $1 million, focus all your energy on your investing returns, and focus accordingly depending where you are.
That was the one. Yes. Thank you for sharing.
All right. We have a question from Veronica and then William.
Thank you so much for talking to us today. It's more kind of, a personal question. In the most difficult time of your, let's say, development, what helped you to keep going on and not giving up?
Great question. By the way, I like how you guys have raised your hand. It looks like you're giving me a high five. The most difficult time. So I started putting money into the markets in 2004. I would say that I had some semblance of what I was doing in 2007. And then came the great financial crisis. And I vividly remember the fall of 2008 when I was contributing big amounts of money. At the time, we didn't have any kids, and we had two incomes. So I was contributing as much as I possibly could to the market. And I just remember every time I did so, I immediately got punched in the face with a massive negative return, right? I put money in the market in September 2008, lose 15%, put money in October 2008, lose 15%, November, lose. It was like getting punched in the face again and again and again, even though I knew that I was doing the right thing. By the way, it was a very scary time. We were seeing layoffs left and right. In fact, the company I was working for went through layoffs in February of 2009. So I saw that people that I worked with were losing their jobs. I saw just how hard it was going to be for those people to get employed anywhere else. There were calls for the Great Depression Part 2, we had massive spending and stimulus. There was political upheaval. It was a very, very scary time. Now, looking backwards, it looked like a wonderful time to invest. And it looked like it was all sunshine and roses starting in March 2009, where the markets have gone just straight up since then. I can assure you it was very painful if you were investing during that time period to live through. Even in April of 2009, which from then on out, the market was going to go straight up. If you read the news, there were calls everywhere for a double dip, This is a suckers rally. The next drop is just around the corner, and that sounded logical to assume that. And then the market went up again, and okay, now this is it. Great time to unload your stocks and wait for the next big crash, which of course was horrible advice that you should have been buying hand over fist. I see the same exact things happening now, right now. What we're going through, by the way. And I have no idea what's going to happen next. The stock market could fall 25% from here. And I would say, well, that makes sense. Or the stock market could do nothing for 10 years. And I would say, oh, that makes sense. Or the stock market could go up 15% per year from here. And that could also make sense. That's why investing is so challenging, because you have no idea what the future is going to hold. But I would say that period from 2007 to 2010 was brutally painful to live through. But man, did it give me a great education.
Indeed. My first education was the dot-com crash, where I lost about 50% of my funds. The second was when you talked about, I remember in September of 2008, they were talking about the collapse of the worldwide financial system. I mean, just this catastrophic terms being routinely thrown out in the press, right? Yep. And Warren Buffett came on and made a very optimistic and positive statement that really kind of steadied my nerves. I mean, he said, no, I believe in the future of American business. So it's going to be good. And this is where we as individual investors have to focus on. Look at the history of the market, have optimism and confidence that have the ingenuity of those people who are running the companies that we're investing in, that they too shall thrive, and we will thrive along with them. Long-term perspective.
Sonny, do you remember 2009, how people were screaming about hyperinflation right around the corner?
Mm-hmm. They've been screaming about that for 10 years. Finally came true. Not hyperinflation, but some inflation. But it took, what, 12 years for it to... That truly taught me. I remember gold bugs were screaming about the dollar was going to zero and everyone should buy gold and buy silver. Hyperinflation was right around the corner. All of their arguments seemed so logical. Right. So logical, right? The data was just clear as day. Look at the money supply; it skyrocketed, and yet what happened? The next decade was the period of the lowest inflation on record. Yep. Right? That just made no sense to me, but it just showed me firsthand just how hard macroeconomic forecasting is, and why you should ignore everybody out there that says this is what's going to happen next based on this data. I'm sure they are convinced themselves, and I'm sure they're a really good storyteller, but I just know in my heart that no one can make those predictions accurately. And another thing in human nature, that if someone is coming at you and giving you a great caution and warning, and you've got to get out now, and you feel like you need to trust them, and they may be smarter than me, maybe they know something I don't know, and boy, I'll better do that. It's easy, right? They sound so sophisticated and so smart. But another guy comes along and says, no, I have full faith and confidence that we're going to rebound and American businesses are going to grow stronger than ever. You think, well, they're a naive fool, right? They're an idiot. But guess who's usually right? Mm-hmm. The guy who's got that confidence and and understands the historical trends of the market and a firm belief in the enterprises we're investing in. That's the guy who may sound naive, but actually is on the right track. But another one of those things where we're psychologically wired to respond to danger more than safety.
I'm a big fan of, I think Morgan Housel said it, but it was like, pessimists sound smart, optimists get rich.
There you go. Excellent.
Yeah. So actually, we try to tell the members as well, if they have time to read or follow these economists and analysis, go back and then read Brian's book. Because it's waste of the time, and they are predicting the market, and one year they will be right, because every year they predict that it's going to go crisis. Okay, so we have one more member who wants to ask you a question, and we want to also be mindful about your time, because we used to go kind of 1 hour and a half, 2 hours, but we don't want to happen today. And I would like to also ask you where the members actually can find you around as well.
Mm-hmm. The best way to find me is on Twitter. I'm at Brian Feroldi, just by name. If you're not on Twitter, I have a free newsletter. I put a link in the chat. It's just mindset.brianferoldi.com. Those graphics that I put up before, I just email one of those per week, as well as some other useful links, and it's free.
William.
So William.
Go ahead.
Yes, thank you. I'm wondering what your advice is. I would never do this with my entire basket. That would be a really stupid idea. But I'm wondering what your advice is to someone like me who is looking for the next Amazon or Apple or Tesla or heck, even Bitcoin, if I even want to go there. Like, I want to hear what your take on that is.
If you're interested in individual stocks and you're interested in doing the homework to find the next potential mega winners, I would say read a couple of books. A great one is 100 Baggers by Christopher Mayer. What is this? 100 Baggers by Chris Mayer. This is a study of stocks that return 100 to 1 in the market and has many of the characteristics that all of them shared. It's really great if you're looking at 100x, looking out in the market for 100x investments. The broad things that they suggested go for were small companies, so under $5 billion in market cap, owner operator management teams. So that means they think like owners, because in many cases they are owners. They have an economic engine that works, so they have stable margins. And then the fourth one is enormous sales growth potential. Enormous sales growth potential. Sales growth is actually the engine that really drives long-term market returns. If you look at any company that's been a massive winner, Tesla, Microsoft, Amazon, Apple, Netflix, etc., all of them have enormous sales growth from when they came public. I'm a fan of that style of investing. I like to find small companies and put a teeny tiny bit of my capital into them, say 1% of my portfolio, sprinkle that around, say 20 ideas that I think have large potential, while still trying to minimize risk while doing so. Right? It can be easy to go out there and find a company like Nikola, for example, and be like, oh, they're just getting started. They have this enormous runway ahead of them. But if you look at the financials, it's very clear that company was garbage. Right? They had no revenue to speak of. All they had was a story and a $30 billion market cap. So that is extremely speculative of companies. Some companies that return 100 to 1 are already profitable. They're just teeny tiny and they have a huge growth runway ahead. So I still emphasize business quality, but I see nothing wrong with doing the research to find, say, 10, 20, or 30 of them, make small bets in each of them, and then track and then see how they do. But you must have a long-term time horizon. You must have the ability, the willingness, and the ability to withstand huge amounts of volatility. And you have to be willing to own them for years and years. I think the fastest 100 bagger in the study was something like 4 years, but that was a biotech that got bought out. I think the average duration is somewhere around 22 years. 22 years to get that 100 bagger status. So yeah, but I love looking for them. I hope that we've found some that we've profiled on my YouTube channel. If you want to check out some of the ones that we are that I'm betting on, but. My friend Tom Angle has a wonderful statement about these kinds of companies, which, if this is the next Amazon, a little is all I need. If it's not, a little is all I want.
That's a good one. Thank you. That's awesome advice.
Good luck.
It.
If you find one, let me know.
Share,
yeah,
share with all of us.
I will.
All right. Any other questions from anybody for Brian or for any of us?
There's one that I saw here from Laura. Laura said, she said, you mean if I send my kid to get an MBA, that means they won't know how to invest? That was my experience. So they'll become trained in how to become a manager at a company. I don't know if I don't think they'll be trained to become an investor.
There are a few programs now that start to specialize in investing, but
for sure,
by and large, they're very rare. Yes, yeah, and you have to really search for them. And even then, I'm not so sure that training in academic sense to be an investor is as valuable as actually learning it on your own.
Yep, that's it. You can learn way more from free podcasts, free YouTube channels, and free newsletters than you can from an MBA program.
Yeah, I've taken some courses from Wharton Business School about, corporate finance, how to read financial statements, all that stuff. They're great courses, but they don't tell you how to invest. There's a whole different skill set involved there that go way beyond academics. So
That's right.
I'm an academic. I'm a fan of academics where appropriate. Certainly go to college to learn physics. You might not want to go to college to learn investing. So
The best way to learn about investing is to put money in the markets.
that's right. That's right. All right.
Okay.
Very good. Well, Brian, I want to thank you very much. It's been a wonderful time spending with you, talking about all these things. I hope everyone goes out, especially those who are intrigued by the idea of starting investing, buy the book. We are talking about having a book club here, and I think that would be a great candidate for our first book for our book club. So buy the book and read along with the rest of us. If you are intrigued even further, Brian also has a course on how to read those financial statements to kind of differentiate the great companies from the not so great. And also we in Wealth Angels, which we also do the similar thing. We'll teach you some things to help you learn more about investing in individual stocks. If that's where your interest lies, we're giving you the tools to do that as well. Lots of options, no MBA required. So hope you all join us and take advantage of all that Brian has taught us today. We'll move forward.
Awesome.
Thank you so much, Brian, to be here. Any last word?
Yeah, thanks so much. You guys seem to have a great community here, which, as we said before, is a massive asset. I did want to make another book recommendation for you. Have you guys ever come across this book, Beyond Wealth by Alexander Green?
Yes.
Okay. This seems to be completely up your alley. This is one of my favorite books to read and reread again. It's by a former money manager. But it's almost nothing to do with money, but it is just a fantastic read that I just, my first thought when I logged in, you guys talk about what you do. I was like, oh, like Beyond Wealth by Alexander Green. So fantastic. One of my favorite books to read and reread.
Amazing. Thank you so much for today, for all your sharing, for your wisdom as well, and all the resources you share with us. It was really, really a pleasure having you here today. We are looking for also to see your other Brian.
Yeah.
And then that would be amazing as well.
I know he loves this kind of stuff too. So I'm sure we can get him to do it.
Amazing.
Maybe we'll have the Brian and Brian show here.
There you go. Oof, might be too much Brian for one Zoom session.
Awesome. Thank you very much. And then
Thanks, guys.
Enjoy your day ahead.
Appreciate you staying up this late, Diego.
Thank you.
Bye, everyone. Have a great day or night.
Bye-bye.
Yeah. Bye-bye, everybody. Bye-bye.